Here we go. We've had an interesting couple of weeks. I say that a lot, but this time it really was because we had the CPI and the Fed back to back. But what happened? I made some moves. I got crushed on them. I made some other moves. I did really well on them. So I'm up, but not by that much. And that's okay. I'm a little disappointed because this was the time to really get on it, but we haven't hit the crazy part of the end of the year, which I think is coming. Right now, we have a week left before Christmas, and then we have a final week in the year. And that's the chance for everybody to do what they need to do on this tax year. So by the end of the year, you have to have everything done, whatever you want your tax status to be, because the more money you have, the more you have to think about that. You have to get it ready by the end of the year. And right now, we have a flat futures market. I mean, this is just dead. So we opened down here and kind of came up to this level, which was close to VWAP, which isn't surprising because if you don't know where to go, this is a place to stay. So the fact that we're sitting right on VWAP and we're just kind of dancing on it really tells me that there's uncertainty in the market because nobody's doing anything. There should be stuff going on, but this is nothing. I mean, there's never really any volume to see on the weekends, but I can't even get a view from that. Of course, there's a bunch at the open. There always is, especially when we have a crazy week like we had. But that tells me that there's no elation and there's no panic. If you had either of those, you'd have at least an idea of where the market could go. And what we've had so far, if you look at the bigger picture, is kind of a whipsaw. So let me see how far I can back up. All right, so this is the week. We had the rollover period back here, and then we spiked on the CPI. So this is where my problem started. I, like many people, expected that any beat of the CPI number was going to produce a rally. And in a way it did. I mean, you can see right here, even though it shot up and got just murdered at the beginning of the day, it kind of came back up too, if you were to follow this line, somewhat of a trend right here. So up to where it kind of could have been. But then what happened the very next day? We had the Fed, and you can see both of those in the chart because you have this pump right before the Fed, you have this huge dump, and then when Powell was talking, the craziness at the end because he kind of went extremely hawkish at first, and then he became a little dovish when people were asking questions, and I think that was by design because I think the whole point was we've still got this stuff to do, all right? Yes, we've settled where things are going to be. We kind of have a consensus now, and we're kind of telling you this is what we're going to do. So now you don't have to worry about the Fed not doing enough because that was one of the problems is people thought the Fed wasn't going to do enough. There's people that think the Fed hasn't even come close to where they're going to stop. But right now it looks like this is getting close. The whole year we've been asking like, what's the range going to be? Like, what do we have to do to start the impact of crushing inflation? So what do we have to do to see any results at all? From the beginning of the year, you can see we've been falling, but we've been alternating like where we are on the trend the whole time because people are very unsure. If we zoom in on this, we can see we've had a drop for a few weeks because this is a weekly chart. So it's showing you that we're going down, we're having lower highs each time, which is an important thing because every time we make one of these lower highs, that's the thing to beat for most traders. And what people are thinking about as far as strength on the next few months, you'd have to see breaks of those areas to know that that kind of stuff was going to happen. But we're not seeing that. We're seeing lower highs each time. So this looks like a peak. We've had a couple of weeks of downtrend, but what's going to happen now? So we have the end of the year coming up, and that's what's wild. I don't really know what's going to happen. I'm thinking right now we have two really good scenarios that could happen. One of them is we get the dump next week, and then right before Christmas, we'll get that little change, right? There's a change in you can kind of sense it when you're looking at the markets. You can see like everything's going down, and there's always rebounds in the trend. These like sudden end of the day, timing wise pumps, right? Like the one we had on Friday. That I 100% expected because a lot of times if you have a down week or even a down few days, you have shorts that are way up and they're going into the weekend. They're going into a period where they won't be able to trade. So they have to make whatever moves they want to make before that point if they're up. So they're going to sell, and the time to do it is right before the thing closes, right? That's why you get that huge pump. So if we switch this to the 1 hour, this was Friday. So you can see that we had throughout the day just drops, pumps, drops, and these were catastrophic looking for day traders at least. But at the end, what happened? We had this like kind of beep, and that was the shorts getting out before we got into the weekend because the shorts don't want to be caught when they can't trade. There are people that got in up here and were just way too up to not do that. So that starts the trend. And you think people at the end of the day think, oh, this is it. It's coming back. It's like, probably not. Right now, that's usually just relieving the volatility because there are a bunch of people that are betting on things. And when big moves happen, that's when things start to go crazy because everybody's thinking they're thinking quickly and they're thinking with their emotion more than their head. So it makes these things amplify more than they should. And that's why you get these like end of the day, oh, quick, we got to get out. And then, of course, the people that are already up on the day that are barely up, the ones that are day trading, they're freaking out because they barely have any profits. It's so hard to maneuver this stuff. And when they do, they just don't want to lose it, or they get run over too quickly and they don't know what to do. So you have all this elation right at the end of the day. So I was like, okay, I have some shorts. I'm going to let them go roughly an hour to an hour and a half at the most before the end of the day, because that was when I thought it would turn around. And sure enough, it did. Power hour, it just flipped right around. It was going up the whole hour. And I thought, geez, I got out at the perfect time. I was like, that was what I was expecting to do. But you know, when you're expecting it, it doesn't usually happen. So I thought, yeah, that's what I would like to happen, but I don't think it's going to. Well, it did. So I hit that spot perfectly. But the problem is my whole play got destroyed at the CPI. And it was because I broke my own rule. Right? Like I would have made so much money on these if I hadn't have done what I did. So we have everything going into the CPI, right? It was pumping up the week. And then we said, all right, CPI comes in a little bit lower. Great. Boom. Everything just pops up in the morning really high. And I had a strangle. Like I found some cheap strangles that would have worked pretty well had moves continued. Right, because that's when I want to get them, is when it's cheap to buy long options. The odds of those things coming into play are not it's not good. Like you're not going to get paid on those ones. But when you get those and you actually do, it's really, really profitable. So I was up and I was really happy about that. And the day started and I thought, all right, great. We had this pump and a little dump at the beginning of the day. The CPI came in under what was expected. We're getting the pump. Here we go. But no, people were way too uneasy. It wasn't enough below the estimates, because that's exactly what I was thinking beforehand. So the last number we got was good and it made everything go crazy because that was where I actually had the perfect direction going. I bought a bunch of calls because I was like, this looks like the perfect opportunity to get calls. And boom, it was. And the same thing was happening here, but I thought this time it'll probably have to live up to greater expectations. So the odds of it rallying on a lesser beat would be lower. So the thing doesn't really do much. It looks like it's going to, and then it stays flat. And that's kind of what I thought it might do, or it would crash because of that. So we had that, but that wasn't enough to sink the markets. So it was still very even, right? It came up at all the people that were right or wrong in here. This is a squeeze. So when you see this movement on a chart, this is an unnatural movement on a chart and only exists because there's extreme liquidity and extreme pressure. I mean, people are borrowing ridiculous amounts of money. They got margin that's like 20, 30, 50 times the actual cash that they have, or more than that. It's unbelievable how crazy certain organizations will go too, because they have more capital to do this. And you get these huge unnatural squeezes because those players are moving that. They have to move shares quickly when there are no shares available, because the other people that are caught short are also buying. So that everybody gets caught in this and it squeezes up so quickly. But the fact that it hit that point and just came down was really suspicious. I remember at the beginning of the day, it had hit peak, it came right back down to VWAP, which is expected because you think that's the point of uncertainty. It's basically like people go, oh, this technical analysis doesn't tell you anything. And it's like, well, fair enough. It's all kind of mysticism in some ways. But what also actually happens is the chart plays out the way it should sometimes, because you have reasons to, like the pressure. And what I thought was, if we had all this release, but then it came down to VWAP because people weren't sure where it was going to go, then it could crash. And that's exactly what happened. So I had plays to the upside and the downside. And when I saw the jump, I was so excited. And I took off a bunch of my shorts thinking, here we go. This is the rally. Right? Because people are in denial about the rally. So I expected this thing to have a little bit more power than we were predicting. And it really actually didn't. It kind of leaked downwards if you look at the whole week. It seemed really crazy at the time, but it was basically just like, all right, we have a reason to reprice, so we're going to reprice down to a level. And I don't even know if that level's done yet, but there's a reason why we're doing this. This isn't unnatural. This isn't the end. The reason is we have adjusted the projections that the market is looking at. So the market is always forward looking. It's looking farther and farther in advance. It's not just 6 to 12 months, but that's a good view of like the general outlook. What's it going to look like in the next year? What's going to look like in the next few years? It's like 1 year, 5 year, et cetera, down the line. So we have a positive outlook, but that outlook has changed because the pressure that could be put upon it has become a little greater. So the market is factoring in everything when it factors, what should everything be valued at? Everything we make, all these companies, what are they actually making? What's the hype around what they're making, all put together, going to be worth? And when you take into account how much it costs to get money to do things that will generate you more money, You have to realize the more pressure you put on that money, the fewer people are going to be able to borrow it or want to borrow it. So there's going to be a slowdown because of that. So the top estimates went up by about 0.5%, I think. So the people factoring in what that would do to the market had projections from September that were lower. So everything was weighted against those lower projections. So you think, okay, take all that same information, add it to how few people are going to be adding money to the market. And that'll drop the general value of everything if you average it all together. So that's what the market is kind of doing in some ways. It's kind of thinking about what everything is going to be worth. Like, look at GDP. What is everything going to be worth for this country or whatever market you're looking at, and average it against all the companies that are in that market. Not every company is going to be valued perfectly, but because they're all indexed, they're all kind of being lumped into some group like that. And that will affect how they all trade individually. But as they're part of these things hold them up. So even if they're crappy or even if they're good, they're kind of kept at a certain support, but they can still fall. They fall all the time, and good companies are lifted up because of this, but sometimes stuff crashes. And that's what we had this week. We had that CPI report and it crashed. So I knew going into the Fed meeting, which was the next important thing, that the odds of us crashing are higher now because we don't have that enthusiasm. If we had seen a continuous run after that, and I think if we didn't have the Fed, we may have seen a bit of a run, but because we had those events back to back, there just was too much money at stake for people to go wild with certain things. And the liquidity was probably drier because people want to wait and see what the Fed's actually going to do. So that brings us to the Fed. So I had a strangle, basically. I had a place to the upside, the downside, and things trading sideways. So basically I had things on for every direction, but I broke my number one rule. I traded the early market. I don't let myself do that because sometimes you have to because there are certain things you need to do. I'm excluding those. But when you're making a trade and things seem to be going to your plan, just don't touch it. And I thought, all right, I'm going to try to extend this because we have a rally. So I don't want to keep this money for the shorts on the table. I'm just going to get rid of this. So I dumped it and then things ended up going down. So that was the absolute worst case scenario for me. Not only did I not make money from the longs, but then I lost the thing that would have been profitable. I was heartbroken. I was so heartbroken. I mean, I knew there was going to be a little bit of a drawback at some point, but this went way too far, and that hurt. So I thought, all right, going into this, my brain was already fried. I was ready to just not do anything, and life was getting crazy anyway, so I couldn't do a stream during the Fed like I normally did. I made a couple of trades beforehand. Luckily, I didn't expect much out of them, but because we had the movement we had, I actually ended up coming up on those, which was great. And that's why these are the only events that I think putting a binary trade on makes any kind of sense. You know, when you first get into trading, you learn about options, you're scared of them, and then you finally go like, all right, I'll give them a try. They're not that scary, and you learn them after a while, even though they're very confusing. I mean, most stuff is not confusing in life. Even if it seems complex, it's usually kind of easy to pick up. Options are not, because they're so not intuitive. They're not intuitive. It's so hard to figure out what's going on when you're first trading them or what anything means. I'm sure that's by design, but it's still so difficult that you just getting into them is terrifying. Once you finally figure out like, okay, there actually is kind of a simple way this works, and these are all just different ways of explaining that, then it's not so scary. And you can look at the possibilities that they give you. You have the ability to protect yourself from a drop, or you have the ability to protect yourself from missing out on something like Tesla, because you could have bought calls on Tesla in a ridiculously high range for very cheap that were long-term calls and been somewhat of an investment on it. And during that 2020 pump, that would have come true so many times. I think of like how high Tesla went compared to where it was when I was looking at options and thinking like, oh yeah, I could buy these like $50 options, but look at how far up they are. They're like around 1,000 or a little over 1,000. I just think it went to like 2,400, I think, when it finally split. If you just had those ones that were 1,200 or whatever, that it would only cost you $50 or $20 or whatever it was, those things would have been worth huge amounts of money. I don't even know. That's how crazy it is. It went up so high that it just, with options, you kind of have a sliding scale of how much you'll make on these things until you're deep enough in the money that it's always worth roughly $100 because it controls 100 shares. So that's for every dollar movement in the stock, you get $100 of profit in an option. But that has to be when you're deep enough in the money to where the option moves like the stock does. Because at some point, it basically becomes a stock. That's what I like about options when you're not trading with as much capital. You're able to buy long-term plays they're equivalent to long positions. You do still have a timer on them. It's just a very long timer. So you can hold them for a while and usually get that pump. because they don't drop as hard when things fall because people want to buy the far out options. Once stuff starts going crazy, they think, oh, I want to get this for the long-term ones. And that's where the premium has jumped. The short-term goes crazy, but the long-term one is way up because the people that are in this thing are getting out now. And the people that want in are in a frenzy to get in. So that's why I like looking into those kind of options. Are they affordable on the premium side? Number one, let's say you could spend $30 a contract. You could have 5, 10, 15 contracts, and that's not that bad. So if you can find something like that you can hold for a year to 2 years, you can usually capitalize on some movements at some point, which is why I like them. But I don't like coming in when it's already jumped up because that's when things tend to crash and get crazy. So the long-term ones are closer to stock. You can kind of treat them like stock as long as you plan on getting out of them within a timely manner. So you're still only in, I'm thinking months at the most on these things, because at a certain point they start degrading. Every day you hold the thing, the closer it gets to expiration, the more expensive it becomes to hold it because the more value you lose. And with movements of the stock, that can increase it. So it's good to have something that's far enough out still when you trade it that if things go wild when you need to get out of it, it's not as bad as if you're close. Because if you're close to the expiration date and things change, those contracts are worthless. I mean, if they're out of the money by a little bit, they're worthless. But if you have a good amount of time left, their extrinsic value is still huge. So you can hold those, or you can sell those things for a lot. And that's why I like cheap premium ones that look like they're going to be good later. This is the perfect time to get them because everything's going down. It's going crazy. I'm thinking at least hopefully 2 years from now, but a lot of times I'll have to settle for the ones because the 2 years out are still pretty expensive. We're coming on to a new year, so the 2025s are getting really expensive, but the 2024s are looking pretty good. And those are the things I'd want to trade for less than a couple of months, less than a few months, I should say. Because I don't really want to hold anything too long. Because once you start getting to like the 90-day range, the 160-day range, that's when things start to speed up a little bit. And when you get to the last 30 days, they exponentially drop. It's crazy. So definitely want to get out of those things way in advance. And that's what I'm looking for. So I like trading these things if I can get them. And I put some shorts on. I put some very cheap shorts on before we had the pump. I also had some longs, so I had some profit right here. I didn't take any of that profit because it wasn't that much. I was predicting more of a downward move, so I had some good shorts on, and bam, it just crashed. And by the end of the day, I took a profit on some and held the rest. And then the rest of the week was beautiful. Ended up dumping the final shorts down here. The longs, I still have most of them. They were all really cheap. I went with super cheap plays. I'm talking like, $5 a contract or something kind of plays that turned into close to $100 a contract, which is, you don't really run into those very often. So that was amazing. And having the bi-directional play on was good in this situation because there was so much volatility that it could move huge in either direction. And it did. And the point of a strangle is you want to be able to make enough in whatever direction you go to cover the cost of the side that dies, because one side is going to have to lose its premium. The side that you're making has to exceed that. And if it doesn't exceed that, then you'll be right and you won't make any money, or you'll still lose money. And that's the worst feeling when you're right and you lose money on stuff like that. So I got something cheap enough to where it wasn't a big deal, and those ended up going into the money just enough to where it covered everything and gave me a little bit of profit. So it was like, all right, I made some profit. Great. But I could have done a lot better. If I hadn't have made the mistake right after the CPI of getting rid of my initial plays, because I picked them up at the perfect time. I was picking them up the week before and 2 weeks before when everybody else was still thinking about other stuff. We were hitting these decent low points, and I thought it's good to start putting these things on. So I had this like really beautiful setup, and my number one rule for me, and this isn't for everybody, is that I just don't trade the open. Never go in with the first like hour or two. I like to let the market do what it does for a while and then come in. So closer to midday, when most people are exiting the market or have already exited the market, that's when I want to start getting into it, because usually if it's going down, it's going to be at its low point somewhere around there, assuming there's a bounce in that day, which is not always a bounce. But if you're getting that kind of like check markish pattern that you'll see in those downtrend days, that's where you'll see it. So I like to come in a little before that, see what the behavior is, and then if I have to buy anything, try to get it between 4 to 2 hours before it close, make some moves in there. That's a lot of people say avoid that time, which is funny, because I don't know if I do the opposite of what most people do, but I do it in a way to make sure that I don't lose as much. Like the whole point is just trade like you're going to keep trading. Just don't get out of the game early, because if you run out of money before you're able to finish your plays, I mean, that's going to drive you insane, especially when you're right. That's what I was saying. It's like, it's terrible to be right and still lose money. So with a strangle, I only want to put in enough to cover my movement on either direction. And I did. So luckily I got in again right here before the Fed meeting happened. And Jerome Powell comes out. The rate was exactly in line with what we thought, right? That's what that huge jump is. We got the 50 basis point hike. So everyone thought, all right, boom, here we go. It's ready. It's rally time. we're ready to go. But Jerome Powell came out a little bit hawkish. He was ready to go, man. He dropped it. And then at the end of the day, or at the end of the meeting, I should say, he kind of was taking some questions, so he wasn't going through the prepared speech anymore. And he started being a little bit more dovish. So he got super hawkish in the beginning. He had this prepared statement, scared the market, kind of what I expected to happen, but we hit this low. And then we didn't bounce because it looked like it was going to bounce for a little bit, but it was a bull trap and it just crushed everyone even more. It was a brutal day, so I'm so glad that I had those shorts on. And I got rid of some of them, but I held the rest until the end of the week, right here when I was expecting it to bounce. That's why I mentioned that time. I mean, it was probably like 2 hours, I think. Yeah, I sold a little at the beginning of the day, and then the final bit was like between 3 and 2 hours before the end of the day. Perfect timing on that. It was pretty brutal, but it showed you right here. We kind of came up to a little spot and grabbed some support. So we came up to a spot and kind of settled. And that's what I wanted to talk about today is we have this new contract cycle for the monthlies, right? We haven't gotten to the full quadruple riching yet, which is coming up, I think, on the 30th. That's for the quarterlies. So everyone's going into the next year. All the 2023s are starting to decay and everyone's going for them. The volatility is going up. The short terms, right? The couple of months till, the 30 days till. There are people betting so hard on these short-term contracts right now because it's the end of the year. And we're going to see a lot of people that get busted. It could go any direction and people are going to get busted in this end of the year thing. That's usually when the volatility gets so out of control that everybody bets way too much and then they don't ever want to come back to the market. So we get a clean out of those kind of players too, because they're the ones screwing with the volatility. I mean, we could have a nice smooth transition if it wasn't for people going nuts with things, and especially with borrowed money. All right, so I had the strangle on it. It was enough to cover the losses on the calls. In fact, I still have some of the calls because they're low enough now where I don't care. I'll just grab them if they come back. Great, and some of them I might even add to in better spots because I like the stocks. But for now, the plays that I put on, I'm just going to probably let them go if they come back at all. We still have a little bit of time left before the end of the year. Next week is the final week before Christmas. People are talking about a Santa Claus rally. And a Santa Claus rally can happen anytime in December, really. But the famous one that we're looking for is the one that happens literally right after Christmas. So the last time we had one, I think that was, I don't know if we had one like this, but the last crazy one we had was 2018. It was Christmas, and I remember the day before Christmas, everything was at its absolute low. There were stocks that were so cheap. I remember looking at this one that was like 6 cents, and I thought, oh, if it's 6 cents, I don't want to touch it anymore. The next day, things started bouncing, and they basically stayed in an uptrend for the next, I don't know, 5 months or something like that. People were not expecting it. The market just went insane, and this was the last year before COVID, so that 2018 crash isn't really talked about a lot. But what happened was the day after Christmas was the start of the rally. That's when things went insane. But that whole drop and then rebound right at Christmas was the perfect Santa Claus rally. And I don't think we're going to get that exact thing because that was an extreme rally. That was when we had way lower pressure on the market than we have right now. We had rates that were climbing, but they were still low. I mean, at this point, they were in the 2s or maybe even the high 1s. Today, our ceiling is about 5%. So that was too much pressure then, but we can take double that pressure now. I don't know. That's still kind of crazy to me. I still think we have some more downward movement, but I really don't know. The fact that we didn't go crazy at the open tells me that people are unsure, so they're not doing anything. So I have no idea what's going to happen on Monday. But if we get a bounce, that's fine. If we get some sideways action, some high volatility, some back and forth, see that, I think that's kind of likely. Maybe like a downward trend with some of that almost looks like it's going to be an upward trend. It's just so volatile that it's hard to tell. Once we go through Christmas and whatever the thing ends up being, we'll have that final week before everything restructures. Massive funds. A lot of them are switching their entire, well, not their entire portfolio, but everything that they want to move, they're going to switch somewhere around the first or a little after for tax reasons. So that's when you have the big adjustment. People will sell things in December or before only to buy them back in January. So that way they can take the loss and offset a gain somewhere else. And in 2018, stocks are so cheap because of that. And since then, we haven't had a single good tax loss selling year. I always hope for it, but it never happens. Every single year I come out like, all right, here we go. It's our chance. And nope. Maybe there's a little bit of selling, but it's not that same scenario. It was insane. So I don't know what's going to happen next week, but if we get some massive selling, I'm going to be super excited because that's a good sign that we might have a Santa Claus rally right after that. Who knows what's actually going to happen? It's so uncertain right now, but if we get something like 2018, I want to be ready for it because that was such a bad missed opportunity. There were so many cheap stocks. I think about what Tesla must have been. I wasn't even looking at Tesla at that point. I was looking at Tesla, but I had never thought about buying it or doing anything with it because it was just this company that was kind of a long shot, but it was a little expensive. It was in the 200s and 300s, and Thought, I don't know about that. But I didn't really know where it came from and how cheap it was just a few years before that, and how it's been written off the whole time. And then it became it became the biggest car company of all time. And the stock went to insane levels, which is why part of the other reason why we're having such a huge drop in Tesla. Like, that's one of the other things. Every stock is getting hit right now. And the people that are leaving are the people that need to leave. In order for the market to continue in a healthy direction, a lot of the bad blood has to be flushed out of the system, because it's destroying things. People that are betting on good companies are causing failures in other areas. Like, if you're a commodities trader and you screw that up, you can mess the entire world economy up. So you never know. So I have no idea what's going to happen in the next week. If we get a nice drop, I'm going to be looking to buy. If we get a bounce, I'm probably going to ride most of it, because I don't really trust a bounce until we hit a point that the market feels fair value is at least close. You're never really going to get exactly fair value, because there's always going to be a pull one way or the other as people are betting on future events on top of what's already happened. So you have to look at the candle of now as like now plus the next guess. It's now plus. It's not actually now. So right now people are uncertain as hell. I would think that there would be big movements after an open like this, but it is flat. It just came up to VWAP. It did the exact thing you would write in a textbook about technical analysis. Uncertainty would mean come right here, because where else do you go? How do you find fair value? Well, this little thing right here. When you call customers, and when you had to do this over the phone and all that, you have to tell them, hey, I got you a good price, and relative to something, there's this thing called VWAP. This is a general value of the stock. So we try to at least get better than that or something, so they can sound like they're getting you a really good deal, but they're just saying, oh, we're getting at you close to the very midpoint of what people think. It's just the average of what has happened up to that point. I like it as an indicator like that, but when it actually happens, you think, oh man, is this real, or am I just fooling myself? Because technical analysis really is easy to fool yourself. You can lose sight of what's actually going on, and that's why I don't like ever using fundamental or technical analysis on their own, because the good thing about technical analysis is it doesn't have any emotion or anything attached to it. It's purely based on chance. It's saying, hey, there's a statistical probability that this thing is going to happen. That's why it exists. It's not because it's going to happen every time. It's just because this is basically technical analysis is a list of likely things that might happen. How likely is it in any scenario? Well, that depends upon what people think of it. So you have to pay attention to everything. You can't just pay attention to the one side, and that's getting really bad right now. I mean, people are only paying attention to their own stuff so much. I'm trying to do research, and it's getting harder and harder to do research because I can see bias in everything. There didn't used to be this much bias with everything in the market, but everything in the market has now become so political because everything has just become so political. As social media has grown, it has looked for content, and the content is talking about all this stuff. So that's interfering with the markets in a way that it didn't used to. What you think matters more than ever now. Even though you think, oh, we've got all these new algorithms and all this new understanding and more complicated math and science than we had when we used to use these charts. And it's like, yeah, but that doesn't always do anything. So sometimes you have to have a backup plan. And the backup plan is just look at what kind of happens a lot and then maybe be ready for those type of scenarios. And make sure you're ready to commit to whatever you're doing, because if you change it, you might screw yourself up like I did. God, I'm so pissed off about that. I could have had so much on these plays because I was dead right. I was dead right on the things, but I just thought, all right, I need to get rid of these because they're going to cost me too much, and I want to. No, just hold the thing. Don't. I traded before I said I should. Just my policy is not even to look at the market until it's later. I mean, I get little messages and hints and stuff like that. And sometimes I do look at it, but most of the time I just say, just don't even look, because more often than not looking until the latter part of the day from what I do is way better. If you're looking to pick up stuff cheap, that's the time to do it. So I thought, all right, let's just, as a rule now, every time I trade the open, it doesn't work out. So I'm just not going to trade the open. As a rule, not going to trade the open. Traded the open, regretted it, but was able to get something out of it when I sold at the end of the week down here, thinking like this is where things could bounce because this is where shorts are going to be very nervous. And that's why you see this exact pattern over and over, because what this is an area where people kind of agree that it's a good place to get in or out. If you're a short and you got this much of a candle and you're a good short, let's say, you're out. I mean, you might have even been out well before this got to this point, but if you get this much of a candle, it's time to jump. And if you did, you're very lucky. And some of them got back in when they saw this pump because they noticed it was going above VWAP. It was coming back for the day. Depending upon what your time frame was, you're going to see something similar, that VWAP is either like close or you're past it. And the longer time frame you use, the better, because that's a more accurate representation of what might actually happen. It's a wider view of the field itself. The closer you get, the harder it is to see moves in directions you're not ready for. So that's why I like to back things up and drop the amount of premium or the amount of cash I use in a play down to minimize my exposure to losses. Because what's going to happen most of the time with your plays is they're going to lose. So you have to set them up in a way that losing doesn't hurt you, or it always hurts you, but that losing doesn't hurt you as much. If you can lose enough to continue staying in the game, even if you lose the whole week or the whole month, then you're doing it right. Because there are going to be times where you're just wrong all the time. So people dismiss luck. They shouldn't dismiss luck, because I do, I don't think like I don't know, but that's the thing. I kind of do think that there is luck, because there are just times where you're right all the time in the market, and in life too, the same thing happens, but specifically in the market, there are times where you're just right all the time. Every play you make is perfect, or like 95% of the plays you make are perfect. But then there are times where no matter what you do and how well you play it, you get crushed. And there's nothing you can do about it. You're either right and you get crushed, or you're just dead wrong all the time and you question why you're even doing this. So you're going to have those times. And that's why if you don't change the way you bet based on those times, you'll continue to go. But the downside is you're not going to make as much money quickly. So it's going to take you longer to move to the upside. I say, hey, my growth is going to be slow. I keep my plays low so that I can continue in the game. And if I hadn't have done that this week, I wouldn't have been able to adjust the way I did, because I had to make adjustments right before Jerome Powell came out, because I thought I just didn't want to trade. I was so pissed about missing everything and like letting go of the only thing that would have made me profit, that I didn't really put that much effort into these other plays. It was basically just pure cheap logic. I was like, I'm emotionally dead from this, so I'm just going to use logic for once. And that ended up working pretty well, because I thought, man, I'm glad I made those cheap plays. Even though most of the time those are going to lose, it's still beneficial in an environment like this to do that. Because once we had this big drop and then the confirming drop with Jerome Powell, I knew this week was doomed. I thought there's at least 60 or 70% chance that we go down from here. Once you see these drops, because we had a drop, a little bit of a fake out, and then a drop again. And that just crushed the market right there. And that was the adjustment to what the Fed was saying they're going to do. Not just the numbers that came out, but the tone Jerome Powell had when he came out. He wanted to tamp things down, because he's thinking, all right, we're seeing improvement in inflation. Last month's was one reading. We don't have a trend yet. This month's makes two, and they're both lower, but this one's closer to the estimates than the last one was. And I think that's because both were overestimated in the wrong direction. Oh man, I lost my train of thought. I'll come back to that at some point, hopefully. But basically, I had the downward moves played. I bought them purely on logic, and just the fact, not purely on logic. That is a lie. So some of it was my training, basically. I told myself, yes, it sucks to lose, and usually when you lose, backing off is the exact thing to do. But this is one of the few situations it's worth it to take a risk in, because this is when volatility is going to move things the most. And it did. It moved him to the downside, which is why, even though I expected a little bit of a rally that I didn't get, I'm not surprised this happened, because this made sense the whole way down. So I wanted to have the exposure to that direction in a way that would cover my calls, because I didn't spend a lot on either direction, but I really knew that this was the chance to make some money. So I put a little bit more than I normally would down. And since I've lost a bunch of my cash recently, I couldn't put as much as I would have liked. My risk profile doesn't look the way I would like it to look, but I had to make something, because logically and emotionally, I knew this was going to be the time when things move. So put that play on, took advantage of it, got out at just the right time. I wish I'd kept them all down to there, but getting rid of, I think most of them, or at least half of them down here, was nice. That was just the crown of the whole thing, because up here, I was so pissed. This moment right here, when it came way down and it never came back, because once it got down to like here, I thought, okay, we've been in free fall for a couple hours now. It's over. I knew we weren't going up. So at that point, I was so pissed, and I just kind of didn't do anything. I looked for everything. I tried to get out of it. I thought, man, is there something I can do to fix this? Because I just made the absolute worst move I could have possibly made. And nope, there really wasn't much. So when we came to the actual, I got a night's sleep. I thought about it a little more, came back a little clear-headed, and made sure I made some adjustments, I think, on both the uptrend and the downtrend. So I got lucky, where normally I have to buy the plays around the same time, because you never know where it's going to go. So you might think, oh yeah, I'll just try to get the upward plays when it's down and the downward plays when it's up, and it'll just be smooth. Like, nah, it doesn't work like that. So when I actually was able to do that, I was kind of surprised because I thought, all right, it's been up a little bit. I didn't really want to trade, but I got in right around this area because this was right before that drop. So I made a bunch of downward plays and then things were right. And I thought, I should protect these gains with some upward plays. So I got those and boom, then it popped right there. And I thought, all right, these were the things to have. And it would have been nice to get rid of those there. But actually, wait, I got rid of something there. That's right. Yeah, we had a pump. So I thought, all right, I'm going to take some of those gains. And that was the good part. So I did get rid of some of those upward plays. I had a bunch of calls and they were all cheap. And I was able to get a little, that's the thing, it wasn't a ton. Like the ones that went up didn't really move that much. One cheap play I had was Ford because I was experimenting with a way to grab certain parts of the market. And I think Ford actually is a way to do that for a cheaper price. But I was able to just make those moves, get a little bit of something, cover those losses, and then make a tiny bit of profit. It was great. But it's good to have my cash back. That was the sad thing. Like I was already so low on cash when all this happened. And if I just gotten out of these plays, the ones that were way up, and I considered getting rid of a couple, but didn't really want to. Oh man, if I'd gotten rid of those and then held the other ones, it would have been great. So coulda, woulda, shoulda though. It doesn't always happen like that. Sometimes you come in, you think things are working perfectly. I've got this, and other times you think you can never do it. But I went through both of them this week. I went through both ends of the spectrum. I wanted to quit. I hate everything to like, all right, this is awesome. I'm making money again. So still back to where I was, a little bit above that. Very cool. But again, stifled. I had a really great year up until this end part. And I've made a lot of mistakes. And the biggest one right there was ignoring my rule. I thought because this was a different event and I wanted to pay attention a little closer that I should do that. But no, I just really shouldn't have. If I had waited and checked the market in the middle of the day, I would have been like, oh, good thing I bought both. So I would have been so happy if it had been right here when I got to it. That would have been great. It sucks when you think about the market going on while you're not paying attention to it. That's one of the worst things. Like you know that things are happening and you miss such great opportunities sometimes. That's the downside of using this strategy. Maybe like when it opens, I'll check it or something. But then after that, I'll just sort of let it go. And most of the time I won't even check the open because I don't want to start myself down that path. And a lot of the times that's the right thing to do. But when it's not, oh, that's frustrating. So the strategy does have its drawbacks, but for the most part, if you want to grab some upward stuff, that's the time to do it. So I kind of do that. Actually, the thing that really made me do that was I've never had a successful, well, okay, I've had like 2 successful trades in the morning, but besides that, those were easy ones. Those were ones that there was no effort involved in those sells in the morning. It was like, it level changed overnight. It's like, okay, here we go. I can sell whenever I want. No big deal. Those are the great ones. You don't get those all that often. So when you get something, you want to take it. And I took it in the wrong direction. I should have just left everything on. So if I had listened to myself, this event would have been so much better. But I didn't, and that was the one mistake. I did everything else right. I used logic to grab those plays before the Fed meeting because I still had the upward ones, thinking like, oh, I'm just going to hold those and get rid of the down or because I didn't have the down left, just leave it. Because if I try to buy the down now, it's going to bounce and that's just blah, blah, blah. And it won't go as high. And that was the other thing that I thought, all right, this is going to be a vol crush week. This was what told me we're going to crush in every single direction. Because if you look at this drop, we have these brutal turnarounds, and I kind of expected that because that's what it started with. It's an echo of the thing that originally moved it. The CPI was the piece of information all the algos and all the traders were waiting for. They got it. Things got confused, and we had this. And Jerome Powell said, all right, we've already got what we wanted. I mean, we didn't want this thing to go out of control because if CPI came in quite a bit below what it was supposed to be, we would have had an extreme rally, and that wouldn't have been a good thing because the whole point is to keep everything low. And it's not like the stock market is the thing that controls it all. It's like, no, it's all one thing. They're all connected. So if you see movements in these one markets, it can exacerbate movements in the other markets. Whether you mean it to or not, the blocks between these markets are never going to be good enough to prevent money from moving. There's always going to be some leakage in some way. And things just naturally move where they move. So it's not just that stuff is leaking over into other areas, it's that it's naturally going into those areas. I mean, you think about the commodities market, and that's tied into pretty much every business you see in the stock market because they're all buying materials or services from these commodity markets. I'm rambling on this subject, so let me get to somewhat of a conclusion of all this. So we had an interesting week. I made some money on that, but that tells us something about what's going to happen. We have virtually no reaction at the futures open. And we've had hours for something to happen. So that's when things are right there on that VWAP line and you're hugging it the entire time. There's no way of telling what's going to happen tomorrow because it's the week before Christmas. So things should go insane in some direction because of that, but we have no indication of where that might even be. Volume is low. We're just kind of sitting there. So I'm prepared for both. If we go down, like I said before, I'm probably going to look at continuing to add to the longs as we do, because I'm ready for a really long bear market if it comes in. My strategy makes sure that I'm going to continue playing the game for as long as possible, and I've got a long time if necessary. But I don't think it's going to last that long. I mean, it's good to be prepared for that because it's, I mean, if you look at history, it happens. It hasn't happened recently. The way we conduct our financial system now, it's very unlikely that we're going to do the exact same thing that we used to do because it's a whole different machine now. It's based on the same basic principles, but because of the things that we've done and the way we've run it, it's a whole different world. So who knows what's actually going to happen with this. But next week, there's a chance for a lot. So if we get a bounce, I probably won't be touching much. I might let go of a couple of things, but I don't want to short a bounce at all because this could, for all I know, be the bottom. Sometimes the Santa Claus rally, like we had one year where it looked like we could have a Santa Claus rally, but it started really early. It might have been early December or even in November or something like that. So sometimes these rallies are earlier than you think. And I never expect to know what's going to happen because that's one thing I've realized is the market likes to do the thing you don't think is going to happen and you're not expecting it. Or you don't want it to, I'm sorry. So it's something you're not expecting and you don't want it to. I've been saying that a lot over the past couple of weeks because I'm realizing that is what happens a lot. We see this trading. You can look at VWAP and see that it was under VWAP the whole time. And that's the other thing that I really like about it is if you can tell how the market feels based on where it is relative to VWAP. When we were going up to those points, it was above it the whole time. All these green arrows were keeping it above VWAP, and every time it touched it, it bounced. So part of this was day trading, but part of this was everything that was happening in the news as well. And as it pumped at the end of the day, VWAP had to adjust. So the next day we kind of had some uncertainty, and boom, we passed it again until we got to the CPI in that morning. Because this might have been the early morning trading. This was either the end of the previous day or the beginning of the early morning trading, but at some point we had that CPI pump and everything just went awry from there. So I'm ready for whatever comes along after that. I don't really want to get too sucked up into either direction, but if it ends up being a long bear market, fine, I'm down. That'll crush a lot more people though. There are people that are hanging on by a thread right now. And if you look at the bigger picture in this market, okay, so here's the overall market over the past few years. I'm going to zoom in a little bit more so we can get a better look at where we are. This was the 2020 drop. This was the 2018 drop. So I'm glad we have that on the radar as well. That's why we had so much liquidity in this area when we passed through it. This was the point at which the market hit free fall before. And if you look at that, we were already in free fall when we hit that point the next time. So that's why this was an extreme drop because we had this thing falling so quickly that the bounce just was insane. And we're paying for that bounce, but look, we're still above it. This was the old top. This was the thing to beat after an insane rally. Look at how much green is right here on this rally and right here. This was what I was talking about, the Christmas rally of 2018. Since that, it's been absolutely insane because this is where around the time they decided to start flipping interest rates again. It was up at about 2.5%. And they said, okay, fine, that's too much, we'll drop it. And after that, the market said, cool, all right, we can rally again. And yeah, eventually the rally kind of ran into some problems and it looked like a head and shoulders, right? This is what people would have thought would crash the market. When you see a head and shoulders, that can be a really big one, but it only happens, I mean, so much. I've seen so many head and shoulders that don't come to fruition. So I've kind of stopped paying attention to it unless it's on a big time frame like this, because this shows you that like the bigger or that the bigger fish in the pond are thinking about it. If it's on like the daily or the hourly or anything like that, you're not going to have the same caliber of people. You're not going to have as many people looking at it. But when it's on a huge timeline like a week or a month, that's when you're going to have certain people that with a lot of money that are ready to make moves in that position. And at the same time, that year, we also had the repo market crisis. And that's one that people don't even think about anymore because everything went to the pandemic after that. Right before the pandemic, we had a problem with liquidity where banks weren't lending to each other because a lot of people believed certain banks weren't going to be able to pay. So there was this fear that certain banks were insolvent and everything kind of locked up. So the Fed stepped in and went, all right, we'll pump cash into the system at the rate of whatever percent to keep things from crashing. So it went up to like 10% quickly. It went from a few percent to just boom, 10% all of a sudden. So the Fed brought it down to like 4 or some. I don't remember exactly, but it was significantly below where it peaks. And the Fed basically said, we'll do it at this price so it can never pass this price. And we're the ones that print the money, so we do whatever the hell we want, basically. Like we can't, we have standards and blah, blah, blah. Yeah, but you can find a way around it. I guarantee you at some point, everybody in every position has done some shit like that. So I wouldn't put it past the Fed to do that. But at the same time, they are still trying to play by the rules. And people that think that this is all a scam and nothing's real aren't paying attention to the system. Like, you don't need to fake everything when you can let things actually happen and just interfere in the slightest ways to make them happen in a better way. Like, we're not always, it's not that this is one big menacing plot. Like, you got to pick every little player and make sure that they're doing all the right things at all the right times. No, it's just the fact that if you let things play out the way they play out, you can kind of enhance them or hold them back a little bit, depending upon what you do. And our financial system allows us to do that. That's what lending money and debt comes from. It comes from the ability to expand faster than what you have. It comes from the ability to be, well, originally at least, honest about where your projections would be in the future, so that the value they could put into you now would allow you to get to that point. And that's a good thing, because if you just give yourself value at what you have and there's no growth, you can't get anywhere when you're maxed out. So having the ability to move beyond max in order to grow yourself enough for that max to not even be a problem anymore, you need the ability to do that. And that's what our financial system has. You're allowed to get loans above what you make so that you can pay them back, and the people that take the risk can get something. But of course, things are so crazy now that there are certain people making so much money on loans and other people are getting into so much debt because of loans that it's just not equal. It's not fair. So we have problems with our system. But originally the point was to do that, allow you to grow. So we have this system that allows growth the way a static system wouldn't. But how do you regulate that, or how do you make it so that system is completely fair? I don't know. We still haven't figured it out after thousands or millions of years, however long we've been doing these. Because I'll bet we've been doing systems like this for longer than people think. I'll bet, before we were even Homo sapiens, we were probably doing some sort of like trade, had some sort of economy of sorts, because economics doesn't just have to do with people that are, it has to do with systems, not people. So you can have completely independent systems that, let's say by your standards, don't even have intelligent thought, but could still apply those principles, because they happen in all walks of life and just in all areas. So economics isn't just about the specifics. It's also about the generalities and the things that happen. If you watch that over time, you can tweak that. You can make changes to what goes on in our society. And that's what we did. We took a system that worked, over thousands of years, and we kind of turned up the volume on it a little bit. But the problem with turning up the volume is once the freaking hose starts to decay, then you got water leaking everywhere. You got problems, and the whole system's going to collapse because it's above the amount of pressure it's supposed to have based on what it is. So there's risk to a system like that. So how do you mitigate that risk? Well, we kind of figured it out in modern times. People wonder why the system is the way it is. It's because we slowly moved inch by inch in a direction that allowed us to actually exist this way. It wasn't like people were able to profit the way they were. And I'm talking about everybody, we're not talking about greed profit, but just in general, like the benefits to society have been exponential, because the more you have, the more you can produce. It's just kind of a law of everything. It's compound. Like, compound interest is important because that continues over time and it gets greater and greater. The more you put into it, the greater it is. And it's something you don't have to do anything for. It's automatic. It pays you all the time until you either sell the investment or the investment goes away because it has problems or something. But still, it's good to have assets like that. How do you control a system like that? We're kind of figuring that out. And that's what the Fed is trying to do. The Fed is taking what actually happens and just turning up the liquidity. And I'm sure there are other games that are being played, but at a base level, it's how much water are they shooting through the pipe, and how are they, and also they're doing other things. It's not just how much water is going through the pipe, but they're putting as much pressure on the market as they can. They engage in trading in different markets in order to set floors and ceilings on stuff, basically. So if you have an entity out there that will fill your order at any price, you essentially have a stable price that you can bet on. But as things, as scarcity, supply and demand, stuff like that move around, you'll have fluctuations in the price of that. So just having that asset could be more valuable over time. That's why I like to hold assets long term and get them when they're cheap. And right now, since we have a down year, things are cheap. We've had these pumps and they keep happening, but the question is this a lower high right here? Because if it is, and we don't come back to that, is this the bottom of this range, or are we going to continue to have another one of these like pyramid shaped shots? It's just a triangle over and over again. We had the actual Head and Shoulders at the top. The thing, when I saw this at first, I was so skeptical. And this is so typical of really big Head and Shoulders. This is kind of similar to Bitcoin when it peaked back in 2017, 2018. It had, at some point, it had a peak. I don't know if it had a perfect Head and Shoulders at the peak, but when you got to where the bottom of the volatility was from the peak, it had a retracement below that and right back up to it, just like the market has. If you put a line right here, you can see that there's kind of a top. There's kind of an area where things were congested. There is some volume on here. And if we go over to this other chart, which actually shows us the volume profiles, we have areas where the volume picks up, where there are more buyers. More shares have changed hands. When people are assessing their risk, they're assessing it at these points. So I guess that's the important part. You think about, why does it matter how many people bought at a spot? Because that's a spot that people are assessing their risk at. That is a spot that elicits more emotional moves than other spots would, because there's more to lose at that spot. This is where people became profitable and got out of their shares. This is where people sold for a loss. This is where people are just starting their position. This is where people have been in their position forever and just added to it and adjusted it a little bit. So this is a very heavy area. And it's likely that the stock will come back to these areas because of how many people own it. But the question is, now that the market has been repriced because the summary of economic projections has been updated, what is the new market price? I've been talking about that for the past few weeks. We have a general market price, and that's what the market's looking for right now. This volatility has been the market searching for it. It hit an area where you can't necessarily, but I wouldn't necessarily call it a bottom, even if it was, because we hit an area where the pull back to the upside was just so great that it had to express itself. Like, people had to take their profits. People that were chasing the thing had to get in there and allow the people that were getting out to get out. And somebody to take the fall. The bag holders had to get in and hold the bag down here. But after that, the same thing happened in the other direction. We've had so much movement to the downside because there's been so much adjustment. The Fed says up here, money is very cheap. It's almost free right now, and not really free, but for the Fed funds rate makes the initial lending very cheap. But at some point, we're going to turn it up, and we're going to turn it up starting in March. So the market knew, all right, something's coming. We had that meeting. Boom, pressure was relieved. It wasn't as bad as we thought. Actually, things are looking a little bit worse than we thought, and companies are reflecting that in their reports, even though their reports for that quarter are fine. Some are bad, but during this time, this was hilarious because I was looking at so many companies like they're beating by a lot and they're dropping. What the hell is going on? These companies are guiding down because of the estimates given at this point. This pressure was relieved because of the shorts. They got in, they were making their profits, but also it wasn't as bad as feared, so it squeezed. And every time we had a meeting, it was the same thing. Not as bad as feared. When we got down here, things were extremely negative. We had a huge bounce because of that, but we went up to a moving average. We went up to an area of decent volume. We got up to a point that had been messy in the past, so we bounced off of that. We came a little bit lower, and that's when I think people were more negative here than here, but we still had some pretty good negativity. And since then, we've come back, and we've been on this tear for a while. But this tear right here and this one right here are much quicker. You can see each time there's less force behind the shot, and it takes a longer time to make the same or similar movements, because this moved a little more, but not by that much. This did it in 3 weeks and came down. This one took a couple of months. So it wasn't the same thing, but it was still quick. And this, we've had waning force as we get up closer to these moving averages, as we get into this area of higher volume. This point right here has a lot of significance for traders and for long-term investors. There are a lot of people that are in right here. There are a lot of people looking at these moving averages. They're looking at these peaks, at these areas that had high resistance and support before. They're looking at the volume coming up, the average volume. Is it above that? Is it below that? So they're looking at all these things, and we're within a range that would show that. But look at where we are. We're sitting on the area of most volume in this entire trend. This makes sense as a spot to chill for a little while because we've had this crazy movement. So people that are in right here, the question is, are they still going to be profitable when the repricing of these new projections is in the market? Because they could be a little bit underwater. And if they are, that's going to cause things to move a lot. But if people are still profitable, then I can see the rally starting sooner than we expect. It all depends upon what's going on right here. I really don't know. I mean, more people are long just the general market way before this in terms of who has a lot of money. Yes, they've been in the market the whole time, and their gains are on top of that. And there are those people that are just sitting on gains. They don't mind if they lose because they have so many of them. But there are a lot of people that are sitting on gains that they have to take now because they barely have anything. They've lost a bunch, or they're close to break even and they just want to get out. So there's still so much emotion holding the stock at this level. And we have the possibility of a panic this week because we panicked at the end of last week. This bounce at the end could have just been the short squeezing. But the fact that people aren't hurrying into the stock tells me there's not a lot of enthusiasm. So I don't necessarily think we're going to go crazy. But at the same time, who knows how much of the downside we're going to get. I wouldn't be surprised if we had some sideways action. That is just seeming so likely at this point. I mean, anything could happen. This is the week I'm most uncertain about because it's so extreme. But I can see that hitting everybody hard. If we had a sideways week, most people are expecting such a massive jump in either direction that they're going to get killed in the premium because they're going to pay these high premiums to make these moves. The move isn't going to happen because they're going to be buying short-term options, and the sellers of those options are going to reap those profits and be able to get out. So I think if that happens, it'll be really good for all the option sellers. I should say just all the general market volatility sellers, because they're selling the volatility. The volatility is coming in. The event doesn't move it as much as possible. Then the volatility drops, which then drops the price of all the derivatives that are attached to it. So in my case, options, the premium is gone quickly if nothing moves. And I kind of expect at some point, because of the movement we saw last week, that could happen, because the way we moved down was very much like a vol crush kind of move. It wasn't a smooth move down. It was very jerky, and there were times where premium just dipped so low that there was ridiculous panic selling, and people were getting out with not as much as they could have made, or even less than they put in, and things just went insane. But when you have a nice steady downtrend, people are able to get in and out a little bit easier. Since we didn't have that, I wouldn't be surprised if we had more of that leading up into Christmas, because there's so much uncertainty about what's going on with the Santa Claus rally. What's going to happen after Christmas? There's exactly 1 week before the end of the year. Everything lines up so perfectly this time. It's ridiculous. So we'll see what happens. Since Christmas is on a day, everything is closed. Well, most stuff is closed, but it's I believe it's on a Sunday. So that means that the futures market could open on Christmas. I don't really know if it does. I'll have to look that up. But if it does, that's a chance for extreme volatility, right? Because that's a chance for people to start getting in, but that's not going to be a bunch of the volume because most people can't trade. So we'll have to see what happens on Monday. If there's huge movements in the futures before the market opens, assuming they open the futures at the same time, then that could show you that there's going to be an extreme movement, which would get people at the beginning of the day in quickly and in emotionally, not necessarily logically, because we could definitely have some crushes to the other directions. I'm so excited to see what happens. Normally I have somewhat of a prediction of what's going to happen. In this case, I don't. I have no idea what's going to happen. I think that we're going to have some crazy movement, but I also think that movement's going to be rejected in both directions at some point. So we're not going to have the extreme move that we think. It's going to be a more general trend in some ways, but it's just going to look like it's a rally going in either direction over and over again. And if that's the case, that's going to be difficult to watch. So I'm going to keep that to a minimum. I'm mostly watching some long contracts. I've still got some short contracts. I'm expecting certain stocks that have been crushed the most are the ones that are the most likely to go down at the end of the year, especially if we have a general tax loss selling year, because people might even be selling the general market. Even profitable, good products are putting people underwater. So it's not just the crappy stuff that's being sold. The people that talk about this usually focus on the crappy stuff, but the good stuff gets sold too. I mean, it's all about who owns what at what time. If you got in late in the bull market, you're probably stuck in some terrible trades, and there's so much incentive to get out of those trades. And they might even be good ones, but you don't know. Not everybody knows what the good ones actually are. After you've been in the market for a while, you kind of get a sense of what the general good stocks are. The ones that, like, hey, if I own stock, I could own any of these and I'd feel at least somewhat comfortable with it. And those are the stocks that are the good stocks. I mean, those are the ones that everybody realizes are the good ones. And you can see that if you look at it, even if you're a beginner, but you don't. It takes you a little while. Like, it takes you a couple of years to just kind of feel where certain stocks are, not have to think about it. Those are the ones that I like to play during these moves, because those are the ones that I expect to stay with the current. So it's more about what is the current going to make everything else do. That's kind of my strategy. I don't necessarily think about specific events. And I sort of realized this when I was doing research. It's like every time I do research, I don't find very much to do. It's just, I don't find something that's like, oh, there it is. There's the thing I've been looking for. Like, I never find that. And I really don't find something that's like, oh, that's interesting enough to where I'll think about it all day and actually want to make a trade on it. Nah, it's usually just like everything's terrible. None of these look good. So sometimes you have to do research. You can't just not, but sometimes you have to just let your gut sort of tell you what looks good. Those stocks that you realize are good stocks and they float with the market, they go with the stream. Those are the ones that you can choose from now. When you're looking at the whole market and you go, oh man, I don't know what to buy, because everything goes up in a bull market and everything goes down in a bear market, in a general sense at least, not specifically, but for the most part. So it doesn't matter which way I go with this. But right now, I don't really know which way to go with it. So I have my upside plays. I'm just going to sit on those. I have a couple of downside plays just in case. I'm thinking about making some more moves, but it depends upon what the market does. And then next year, it's going to be a whole different ballgame, because we're going to have an adjustment of everything, and we'll have a chance, because we were down, to have an up year. Even if it's just a slightly up year, expectations are lower. That was what I was saying about the CPI earlier, and I don't know if I finished that thought, was because the previous CPI was so low in expectations and it blew through it. The expectations to the other direction was stronger. So once they hit that, it was harder to break through the ceiling that was above it, and they didn't. That's the reason why everything kind of stuttered at first, and the Fed took advantage of that, so they crashed it. Now, is it going to stay down because we have to find the new price based on the summary of economic projections, which has everything to what interest rates are going to be, to what they think GDP is going to be? But whatever it is, it's still just an estimate. They're right some of the time, they're wrong a lot of the time. Most people are wrong a lot of the time, because life is so complicated, so difficult to actually predict, that you're just not going to be able to find the perfect trade for any of the events that happen. And you're not going to be at the right place at the right time very often. So if I trade light enough to be able to take advantage of that, then one day I'll hit the right one that'll really move it, because you'll be right at the same time you'll have the correct plays on. You won't just get lucky and be in something that takes off. Because I would say like half the time, the wins that I get are the ones that are the lucky ones. I don't really lean into stuff very often. And a lot of the plays that have been right have been ones that I haven't had a chance to lean into. So I've just been on the right track, but I haven't really been perfect, because recently a lot of the wins that I have are followed up with a mistake or something like that. Something that could have been easily remembered to do. It's been rough. So I'm just kind of rambling about this because we're in a new spot. I really don't know where it's going to go from here. All I know is we're looking for the repricing point, and I would estimate that after the craziness wears off, we're either somewhere in this range that we've created here or maybe below it. So I would guess that the bottom we would see if we continue to go down would be somewhere in the range of this 2020, 2019 area where there are clear areas of support and resistance where a lot of things have happened, where there's a lot of volume. Especially since below this range, there's a big drop in how many people own this stock. So if we come back down to here, the chances that we fall below that are much higher than if we're sitting at a point like this, where there's a lot of support, where there are a lot of people. Their risk tolerance is within parameters at this point, but not by much. So I'm not sure what's going to happen. I'm ready to get in there and do whatever I have to do. So I made a bunch of my cash back. That was the great part. Not a ton of profit, but the fact that I came out with some cash to make plays again was... Oh, I needed that. It's been such a rough couple of months after having such a great year that this last week was freaking heart attack, man. I'm surprised I actually survived it. But what I'm going to do for the next couple of weeks, I don't know. The market's going to have to tell me. This is going to be one of those ones that I'm just going to feel out. I really don't have much of a plan. I always try to say like I have a game plan for what I'm going to do. I don't know, man. It depends. Because now that I'm back at a point where I'm comfortable with my cash and a lot of the plays that I want to the upside for when the next bull market happens are pretty much set at this point, and I'm just adding to as I can. I don't really need to go crazy into anything. And I don't have the cash to really go crazy into anything else. So I separate my cash into the cash that I use for plays and cash that I use to buy. And I pretty much do that by account. I have one count that is 99% long, and it has just a little bit of shorter term positions as kind of a hedge and sort of a trade once in a while. And then my other account has long positions, but mostly is in the trading route. So the cash goes to the area where it's going to be. And I tried to split it as evenly as I can. But recently I've been leaning more into the buying side of the cash, because I know it's great to make the trades, but when the market goes down, you rarely get these opportunities. And I just want to take advantage of them while they're here, because this may be You never know if you're at a bottom or a top or whatever, because this could go on like crazy. There's so many people predicting the end of the world, and some of them could be right. You never really know. So I don't discount the fact that we could be much lower than we are. And in fact, we're going to have harsher economic pressures than we had before. So we are likely to drop, in my opinion. So it's good to end the year on a humble note and get ready for what's going to happen next year. If we get a bounce, that could happen at the beginning of the year. That's highly likely because that's what people are expecting. So the question is it going to be a self-fulfilling prophecy? Most of the market right now tends to think that we're going to have some kind of a recession at the beginning of the year, which I think is pretty likely. I think we could actually have a recession because things are pulling back right now. We've seen actual progress. I think certain people are kind of discounting what that means in reality, but that is a real number. Those numbers are coming down because things are shutting down, because production is slowing, things are slowing, orders are slowing. It's still high. It's still increasing above what it was before, but just not as fast as it was. So that is a decrease as time goes on. That's something that hasn't seen the peak of an impact yet. Every change that the Fed has made months ago is only starting to come to fruition now. So we're getting these little peaks of what this stuff is doing. But once the avalanche has started, you can't stop it if you decide, oh, actually, I didn't want the avalanche to be just right here. I wanted it a little bit more to the left. No, once it goes, it's going. So you just kind of have to live with that. But if you can make the adjustments at the right time, you can actually save yourself from certain things and make money when you have the opportunity to. So my opportunity right now leans more to the upside. I like the fact that things are down. We are definitely lower than we were last year, but mentally, people don't want to spend as much. So the cost of good things has come way down. Stocks that I really love are at half price right now, and they're at about half the level that they were in the middle of the year last year. So that makes sense. But it's still a crazy environment, and I still don't know what's going to happen next. And I'm ready for it. I mean, I'm ready to make some more plays if I need to. I'm ready to sit back and let things go if I need to. The next stream I do is going to be next year. I think it's going to be on the 1st. I don't know. I'll have to see. I may have to move that, but we'll see what happens. It'd be kind of fun to do a beginning of the year stream and just start things off anew and see what happens. Because the first day of the new year is going to be interesting to me. It's not always a huge move. Sometimes the move comes a little bit later because I think people have to get to notice the reality that things are changing. Because the availability of certain things is known throughout the year. When you have a huge move and things have kind of gotten to a point where they're stable, you know where you can get shares or where you can get options or wherever the liquidity is. You think, okay, there's still at least some liquidity there. When that dries up, that's when we start to see the panics that cause the reversals. Because the ability for all these problems to stay on the system with not free money, but with easy to get loans that buy them time. So all these companies that have bought time that aren't going anywhere eventually will get starved out if the system doesn't improve. Because those zombie companies can hold on forever if the market continues to go up. Because that's a great environment to be in. But right now, they're not able to make as much money, so that's hurting their ability to even keep up with what they were doing before. So they can get more desperate. They can do some crazy things. You never know. And right now, the market is full of those kind of companies, and a lot of them have already gone away. That's why we're seeing this decrease, because some of the stuff has already died off. And that's good. But, with any of these kind of procedures, you're going to have to get rid of some of the healthy tissue too. So this is like a lot of other businesses, a lot of other people, a lot of their organizations are still going to suffer from the effects of this stuff. Even if they're good, even if they were responsible with all their finances, they're still going to have problems too, because we have to flush out the stuff that caused the problems in the first place. And this is a necessary part, because if you don't let this happen from time to time, you get these massive buildups and things crash. That's why we get 2008. That's why we get the 2020 crash. Things built up to really unreasonable levels, and then when people panicked, it caused these movements. So right now we have a point where people are panicking, and people have already panicked and made rational decisions. The question is, where is the new stability level for the future market? Where is that fair price range? I don't know where it's going to be. I want to let it play out into next year to see what it's going to be. But right now, there's still a ton of volatility stored up, so we could have massive moves in either direction. I'm considering putting on some more strangles that are cheap if I can find them, but I don't know. At this point, the volatility might be so high that it could be difficult to find those. So I'm going to wrap things up. It's been an interesting week. Happy holidays to everybody. Good luck for the rest of the year. I don't know what you're going to do, but I don't know what I'm going to do either, so we're in the same boat. Hopefully, we can all make some money. That's the goal. To not die and to make some money. Those are my two goals. Don't die and make money. I'm a Stockalypse. I usually do this every other Sunday night at 3 p.m. Pacific. I go over my thoughts on the market, what happened, what I think I'm going to do, talk about stocks, options, and cryptocurrency. So thank you for joining me. Hope you had a good week too, and Happy New Year.